Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Welcome to our May webinar. It's certainly improving in terms of the weather. Hopefully at some point the economic outlook will be improving as well, but we'll run you through what the latest outlook looks like. And as has already been mentioned, we'll then hand over to Piers and he'll be taking you through the latest technical outlook. But without further ado, and before the bank decides to replace me with Sam Allardyce, because he's very popular at the moment, let's look through the contents of the presentation. So we're going to look at those economic forecasts from the IMF and whether they're already looking too optimistic. We'll look at the inflation outlook and how that has changed since last month. We'll look at the upcoming central bank meetings and what is expected from those. I then want to just focus on UK and US insolvencies data for companies, because what we're seeing there is a very different trend in the two, but it may also be informative about what could be coming in the future. We'll look at the FX market forecast and if they've changed. And then, of course, there's that welcome disclaimer. Well, welcome to me at least. So let's move on to the first slide and those economic forecasts. Now, you've seen part of this slide already because you saw it last month, but I wanted to focus on this slide again, and particularly what I wanted to focus on was the numbers that we have for the US and Euroland. Now, for both of these economies, we've had provisional data for Q1 GDP, and actually what we've seen here is a little bit of disappointment from the US there. The start of the year has been much less robust than was anticipated, so growth slowed quite dramatically to only an annualized pace of 1%. That will mean that 2023 growth is probably going to underperform a little, so those economic forecasts are already looking a little bit optimistic. Euroland did slightly better than was expected, but let's look at expectations. They're not exactly materially positive. So overall Euroland growth looks to be, broadly speaking, on a par with where it's forecast to be. You might see marginal outperformance. We are seeing some weakness as well in other economies, likes of China, and that could drag down global GDP growth for the whole of 2023. So as I say, looks like those forecasts might be a smidge optimistic already. And with what we're seeing in the US banking sector and the possibility of some credit tightening, I think these forecasts may well get revised down when we get to the July forecast update. Now, if we move on to the next slide and we look at what's happening with regard to inflation, well, there are some question marks here with regard to US inflation. So we've seen a fall in the US inflation rate, but will it persist? We've seen a fall in the European inflation rate, although the latest data, the April numbers, did show a marginal uptick in the headline inflation rates after French and Italian inflation figures overshot expectations and actually recovered from recent falls a little bit. For the UK, it's been a far less significant drop in UK inflation thus far, although there are signs from producer and wholesale prices that falls are on the cusp of being realized. So we may well see those further significant falls in energy prices, in shipping costs, and in wholesale food prices that we've seen recently over the last 8 or so weeks, starting to impact on the inflation rates. And if you look at producer prices in the UK, for example, the output prices are down around 3% from their peak already. So that will start to have a negative impact on consumer price inflation over time. And I've heard a lot from clients as well recently saying that they're looking to just hold on to what they've got in terms of the labor market. So they're just looking to hold on to their employees. So there's far less demand out there for new employees to join businesses, there is still that replacement demand. But overall, I do think there is good news coming on inflation. It's just we're not there yet, and we're still dealing with some base effects on these headline inflation figures, but further falls to come, particularly in the second half of the year, which could further inform central banking decisions. So if we move on to the next slide. So when we were looking at this a few weeks ago, so in between the last call and this one, there was a lot of argument to suggest that we should see a pause in the central bank tightening schedule. We were seeing a number of concerns over banks, both in Europe and the US. We were seeing a number of issues with regard to some of the economic data and surveys that were coming out of those economies as well, and also including the UK. The labour market data was showing the beginnings perhaps of a weakening, a loosening, or an easing in conditions, whichever way you'd like to suggest it. And so overall, it appeared that a pause would be sensible. But we've seen central bankers row back from that recently, particularly in Euroland, where they've really been discussing whether they raise rates by 25 or 50 basis points when they make their decision tomorrow. For the Federal Reserve, it looks like they are going to do one last hike, taking the upper level, the upper limit for the Fed funds rate to 5.25%, and then pause there, probably for a longer period than the market has priced for, and then start to cut interest rates thereafter, probably into the early part of 2024. Now, bear in mind, the markets have another hike priced at this upcoming meeting this evening, but then quite a quick series of rate cuts from the Federal Reserve in the second half of 2023. Now, I think it's going to come later, but the risk is that rate cuts, when they come, are going to be larger than what's priced by the market. So you could instead see of a couple of 25 basis point rate reductions by the end of this year, a bigger 50 basis point rate cut in the early stages of 2024. That's going to be dependent on data and the evolution of inflation. It's also going to be dependent on whether we get more of this banking crisis in the US. It appears a little bit like whack-a-mole at the moment with regard to the US banking crisis. One problem appears, the Fed whack it and resolve it, and then another problem appears, or another two problems appear. So we do need to be mindful of that in terms of how that might inform the Federal Reserve, how that might tighten credit conditions in the US and also globally, because I think that could put a much greater limitation on the additional rate tightening that we see from all major central banks from here on in. So it's that credit risks piece, I think, that will be amplified in terms of importance, even if the economic data doesn't justify rate reductions in the near term. I think it's that credit tightening that will be the thing that informs judgments on rate reductions as we go into 2024. Moving on to the next slide. This is the thing that I think most would find surprising. So the bar chart, the bars on this graph are US insolvencies. The line, the orange line, is UK insolvencies for businesses. Now, we've seen a very sharp increase in business insolvencies in the UK, really, over the course of the last 18 months or so. And yet we've not seen the same thing occurring really in the US. Instead, the insolvencies have gotten less prevalent, less obvious. But if you just look, possibly difficult to discern, you can start to see that we've seen a shallowing off and maybe even a marginal uptrend in insolvencies in the US. The tighter monetary conditions, higher interest rates, more difficult trading conditions as well in terms of higher prices and squeezed incomes for consumers. I think all of those things could see the trend change around as far as US insolvencies are concerned and start to be quite a material uptrend. And whilst the UK chart looks as if it may have peaked, I think this could be a pause rather than a change of trend. And we may well see insolvencies in the UK picking up again when we get into the latter stages of this year and into 2024. I do think that there is a more prolonged period of difficulty for UK businesses ahead, and consequently, that's a more challenging environment. Whether that's high energy prices, high wage costs, increasing in rent charges, or a whole myriad of other cost increases that a lot of smaller businesses, at least, are finding it difficult to pass through the price chain. So. This could also mean that we see a rundown in both individual and business deposit levels. And I say a rundown, I mean a decline. But if you look at levels of commercial deposits, particularly in the US, although they have come off, they are still very elevated from where they were going back to pre-COVID times. So we need to be mindful of the fact that when we're talking about a tightening of credit conditions, what we're actually talking about is perhaps more of a normalization rather than any sort of renewed crisis. But overall, that normalization of conditions with regard to particularly US deposit levels could have a knock-on effect into the other areas of the global economy, particularly Western developed economies. So just watch out for this and watch out for the trends in insolvencies, because that could be, again, quite informative in terms of interest rate judgments and then, of course, how we see the currency markets. Moving on to the next slide. This is our latest forecast for currencies. Now, a lot of people are looking at the US dollar and saying, well, we've still got this trend of a weaker dollar. And to an extent, that's true. But I'd say over the course of recent weeks, those that are looking to sell the dollar have found conditions more challenging. And they found it more challenging against sterling, against the euro, and also against other major currencies. So the uptrend from here might be more difficult to achieve and sustain. I do think that if we are to get tighter credit conditions, then that could actually play favorably to the US dollar. If there's a reduction in dollar liquidity, for example, then that could play favorably to the US dollar. We're seeing other conditions emerging as well at the moment with regard to the likes of dropping oil prices. That could be favorable, and dropping commodity prices, that could be favorable as far as the US dollar is concerned. So just watch out for that. You know, a weaker set of conditions in commodity prices and wholesale prices might end up being favorable to the US dollar. And remember just how much is priced in as far as the tightening for European interest rates is concerned, and how quick they're expecting US interest rates to be reduced. If we see any change to that position, then I think that there are some downside risks to these forecasts. So that's it in terms of what we're seeing from a fundamental perspective. Just switch over to my final slide, which is my disclaimer, and then we'll hand over to our long-term and long-time friend to give us another update on the technical analysis position. So Piers, we look forward to hearing how that's changed. Over to you.
Thank you very much, Neil. I thought you were going to say you're old, and I don't think you're calling me old, but thank you very much for the introduction. Right, so today we're going to look at the way that the monthly charts look, and we're going to look at the potential support and resistance levels we can see there. So we go to the first slide. Sorry, the next slide. Yeah, the first chart. So on here we have the dollar index. And this is the monthly chart with the Bollinger Bands on. I've also got the Fibonacci retracements, and I think it's very interesting. If you look, we see that move up from 2021 up to 2022, where it started to come back down. We can see that the rallies after the initial drop have all been held by that 38.2%. And so that's quite significant. But last month saw price also close below the 20-period moving average, which now becomes an area to watch at that 102.42. So the dollar needs to regain that to stop this pullback lower becoming more pronounced, because the hardest choices require the strongest wills. So this month will be important to see who has the strongest will when it comes to closing price clearly below this 20-period moving average, which is the pink line in the mid of the chart. So what you tend to find is when price is below that, it gravitates lower. And when it's above that, it goes to the top band. So that's the key area for me to watch this month, this 102.42. We've got the Fed tonight, and that's going to be quite important to see where price is after that. At the moment, it is still acting as resistance. And I think there'll be a good two-way fight this month. There should be strong support in the 99-100.40 area. So that should be good support. And if it does we see the dollar weaken back down, that should be where some support and some buying interest should arrive. But if the Fed announces something and the dollar starts to strengthen and we see a push higher, I'd imagine it going up towards the 103.75 area. And round there is where it's going to have to sort of decide, is it going to go up and challenge that 38.2%? So a lot deciding on the Fed, but at the moment you're below the 20-period moving average, the mid of the Bollinger. So that's the key area to watch for me this month as the month progresses. So we go to the next slide, we've got euro dollar. And again, euro dollar, I've put the Fibonacci retracements. I've also put the Bollinger Bands, and along the bottom, I've got the relative strength index. So I had this chart on the last webinar, and there's still a lot of lines on there. So I do apologize. I hate clustered charts. It's difficult to see what you're trying to get across sometimes. But the point that I made last month was we'd just seen a monthly close above that pink line, the 20-period moving average, and we've got to close above it. And it doesn't matter how, it closed above it. Some people say how is never as important as why. However, as a chartist, I'm not interested in why a line breaks. If it breaks, we use the rule of polarity and we say that should be support because it was resistance. And if you look, the low last month was right on that 20-period moving average and price went up. But we now have that trend line coming across the chart, and that's from way back, from 2000. And so as price gets up there towards the 112.75, 113.50, if price goes up there, it's going to find some resistance. It should find some resistance come in there. But what is going to be important is, can it hold the 109.220, 109.60 area? Now, I put that on my weekly charts this week. To me, that's the key area. It bounced nicely off it yesterday, and today is rallying off there. And that's going to be the bottom range I'm going to look at. 109.2060 as a sort of initial support. If price got below that, I think you could see a move right back down towards that Bollinger Band, round about the 107, 107.25. So while dips lower are held by the 107, 107.25, I think that attack higher could continue. But if you get below that 107, then you have to say that the dollar is starting a good fight back here. So we don't know what the Fed's going to do today. We don't know what the ECB is going to do tomorrow. But we know areas we can watch and be ready for. And those are the areas I'd watch and be ready for. If it went to the top side, 112.75, 113.50 area, looking at that chart, and I'd use 109.2060 as a pivot. Above that, positive. Below that, probably going down to 107. The one thing that actually here just makes me a little bit nervous on this rally going up is the divergence on the bottom of that chart on the RSI. We had a move up and it pulled back. Then price has gone to a new high, but it's not confirmed on the RSI at the moment. So at the moment, I'm not 100% that this just goes straight higher. That divergence, I'd like to see that go before getting very bullish that euro dollar goes higher. At the moment, it's still too close to call. I think you watch those levels I gave, the support and resistance. And a break outside those will give you a longer term direction that we're going to go. So on the next chart, we have one of my favorites, the sterling index. And if we look at this chart, this is the chart going back on a monthly basis. Now, the one thing here is last year we had that big spike, which I've highlighted in the pink circle. And that was the Liz Truss sort of crash time. Then that spike happened. And then the next month you had a positive month. And I said it looked like what's called a morning star Japanese reversal formation. And it has, it's reversed the market and the market's gone right back up towards the top Bollinger Band. And so, yes, sterling's been very positive since then on a monthly basis, just gaining each month, slowly a little bit more, a little bit more. But now it's reaching that top Bollinger Band. So it's starting to slow down. And it's also reaching the 38.2%. It's slightly above it on this monthly chart at the moment, but then it's come back down towards it. And this pullback is because at some point we all have to choose. And you have to choose, am I just going to keep buying sterling or am I going to be a bit cautious? And it looks like the market's being a bit cautious here as we get to that 38.2%, the top Bollinger Band. And why is that? If we go to the next slide, hopefully it will become much clearer. We haven't had a quarterly close above that 38.2% since Brexit, despite numerous attempts to rally and push sterling's value above that. It always gets sold off. So I think people are just a bit nervous. And I think what you need to see is you need to see price above the 38.2% and really staying up on that top Bollinger Band, not backing off it. And then you can start to get much more positive sterling and say, yes, now sterling's going up. But just at the moment, I think it's just stuck. So I'd stay with the same sort of price areas that I said last month. I said, as it reaches 65, 75 area, there should be some selling and resistance. And we're sort of seeing that just coming out now. The real shock, as I said, sterling could do is to close above them. If it closes above them, then you have to get ready for a much stronger sterling. But at the moment, I think we sort of back off. It's not a sell signal at the moment. It's just this is where it should stop the rally for the moment. The sell comes if you get back below 62, 63. That's when you have to be worried about sterling overall. And is something changing? People don't like sterling. Sterling looks like it's going to weaken off on a longer term basis. So if we go to the next chart, we've now looked at the sterling index. We can look at what does sterling dollar look like. So this is a chart I've had on for a few months here. And it's quite interesting because we've had a whole period where the old support has acted as resistance. And we saw it for 4 months this year. 4 months, the highs were capped by where the old lows used to be. And we called it the rule of polarity. Old support switches to resistance. But last month, you actually closed above it. And I've highlighted it on the chart. If you can't see it on the chart too clearly, you will get the slides afterwards. I've written it in red, break, and that's the candle that's closed above it. But we've only got one session above it. So it hasn't quite confirmed that break at the moment. You want to have a couple of sessions above it to really confirm the break. And it's worked well for the last 4 months. But just because something works doesn't mean it can't be improved. So now I'd add onto those levels and I'd add 125.65 to 127.60, that sort of 1 cent range as just a cap to watch how strong is sterling dollar. Can it break through there? You know, the Fed might do something tonight and it might fly through there. But at the moment, I'd watch that level first, 125.65 up to 127.60, that sort of range, and just see, is that going to cap it? Support at the moment, I'd put down in the 122, 122.70 area. And I think that's slightly higher because last month I had 121.50, 122 on pullback should be support. So I'll move that slightly higher because we've had that break and say dips lower should find support by 122, 122.70. And that's the level which if it gets below, you have to start to worry about. So if we go to the next slide, this is the Bollinger Bands on there. And on this slide, ignore, that's my fault. I've written Ichimoku Cloud at the top, but I haven't got Ichimoku Cloud on there. I've changed this, just Bollinger Bands. And what we can see is price closed last month right on the 20 period moving average. And it's just fighting around that area right here, right now. And it's very important, this area, because the fight is now on. And with great power comes great responsibility, because if the buyers are going to take that through that and put sterling dollar higher, they need to hold it above there, because that would be quite a big break. Because if you look back historically on this chart, when it breaks through that and holds through that sterling, the 20 period moving average, it usually is the start of a move to the other extreme. So just keep an eye on that. That will be very interesting. Next webinar we'll cover, have they had the power to hold on to that break? So that's a key level for me just to keep our eye on during this month. Does it hold? Because we could find that they haven't got the strength to hold it through there and it backs off there. And then we haven't got the break and it looks like it's coming back down to the downside. But it's just a level to be aware of and keep an eye on during the course of the month. But I will keep you posted as the month goes on my daily, weekly charts, etc. So the next slide is Euro Sterling. And Euro Sterling, Sterling Euro are the same, just the other way around. They're both in a sideways range. And I think I'll probably do Sterling Euro, because I believe most people who watch this webinar look on a Sterling Euro basis. So we'll switch this to Sterling Euro, which is the next slide. And it's the same sort of thing. We have a downtrend going through. It's been stuck sideways for really the last 6 months. It's just been stuck in a sideways range. And in the last 4 or 5 months, it's been an even tighter sideways range. So I would just keep watching those ranges, because we've seen it trade on sterling euro basis. We've seen really that sort of 111.50 area hold all the dips, and we've seen 115.25 hold the rallies. And so keep watching those two percentages. However, you can't stop change any more than you can stop the sun from setting. And so at some stage, the change is going to come and it's going to break out of there. And that's the thing. When you have a range, trade the range. And it's not giving any signal to me as to which way this is going to go at the moment. You could say it's broken the downtrend line. So that's a positive, and maybe we are going back up. But, you know, as other people would say, the Bollinger Bands are widening and price is going down, so price is going down. So there's different conflicts here, different technical signals saying different things. But at the moment, you could say while you're above the trend line, there's a risk we go higher and we're going to attack that 15.25 area. But I would wait for that, because if you get the breakthrough there and the break out of the range, then there should be impulsive follow through and you're going with some conviction. Whereas at the moment, it's all a bit like the fiction, a bit like the other forecasts where it's could do this, could do this. I like to go on fact. I'd like to see the fact of a break. I'd like to see the fact that the buyers have taken control or that price has slipped back down. Well, I've spoken, and that's my slides for this month. I hope you found them useful. The next slide is the disclaimer slide, and I'll hand you back to the guys running it, and Neil.